Hello and welcome. You tune into Rush Hour with me, Ankita Saxena. Well, first up, let's look at the Asian markets, specifically the Chinese stock markets that tumbled again with Shanghai Composite witnessing its biggest single-day decline since the pandemic, snapping its 10-day buying streak. Now, this after the investors tempered their expectations for a robust Chinese economic recovery. The country will put out a detailed plan on stimulus later this weekend, but to weigh in on the situation, we are now joined by Santosh Rao, who's the head of research and partner Manhattan Venture Partners, joining us. Hi, Santosh. Thank you so much for taking the time out and joining us today. Right. Santosh, let's talk about the Chinese markets. You know, the CSI 300 dropped 7%, snapping a 10-day winning streak, while the Hang Seng tumbled to 1.7% as of its final hour of a volatile trade session. But on Tuesday, the Hang Seng recorded its worst day in 16 years, closing 9.4% lower. Now, is the party really over? You know, the positive sentiment that was buoyed by the Chinese government stimulus, is that really wearing out now, or was it just a profit booking that came in after a long rally?
Yeah, I think the whole stimulus package that they had was really a temporary boost, so to speak. This is the third or fourth time that they really injected some money into the system, some stimulus into the system, and we had our doubts. I had my doubts all along that this is not going to do it. So it was just a booster shot to kind of put a floor on the market and just kind of get some optimism back into the whole sentiment. But I think this was not enough. And the market expected, or when they came back from the holiday, I think investors and the traders expected them to disclose more details, which they did not. And that was a huge thing because at this point, they're just throwing money at it. They have fundamental issues, long-term issues, and this thing, the market is skeptical that this will resolve the very basic fundamental issues that China is facing right now.
Right. Also, like you rightly mentioned, is the Chinese Chinese government stimulus really going to get the economy off the ground? Because a lot of experts believe that while this might bring some temporary relief, in the long term, these are more deep-seated, grave problems to deal with.
Exactly. That's what I was trying to get at, because there are some deep-seated problems, the property issues, the customer demand right now, the things are slowing down. It's going to take some time for things to resolve, and I think they just have to play it out. We have to be patient. These stimulus packages, they're very short-term. They're trading. In terms of trading these things, they're really trading calls, but not investment calls. So the outside money is not going to come into the market yet and boost the economy. So it's still a wait and see game. It's a show me story, China is. So you have to really wait and see because, like I said, there's so many issues going on. The property debt, the consumer debt, consumer demand, the consumer is slowing down. The real estate market is down. The tourism market is down. These are all things that really propped up the economy so well. And now those are just kind of wobbling or down. And so it's going to take a while for them to really strengthen. So at this point, all they can do is just keep on. I mean, they've relaxed the banking rules. They've put more liquidity into the system. All that takes a while to percolate down to the ground level. So it's going to take some time. They're doing the things that they need to do to prop up the stuff to spoil the decline, but it's going to take some time.
Right, Santosh, like you mentioned, that foreign money is not going to come and salvage them. You know, the kind of FII selling that we have witnessed in India, now there has been almost like 44,700 odd crores worth of month-to-date selling by FIIs. Well, the Chinese market, are they likely to be a more attractive destination for the FIIs, given that the Indian markets are fairly expensive now, not because, Chinese markets are that attractive per se?
Yeah, to get your question right, are you saying why is the FII down in India? If that's your question, well, I think the Indian market is very rich right now. The valuation is very rich. I think this could very well turn out to be a very healthy correction that the Indian market needs. Because fundamentally nothing changed in India. If anything, I think the recent elections, kind of consolidated their
Right,
position. The
Santosh.
government.
Sorry for butting in, Santosh. My question was more on Indian markets being expensive, and does that make China market more attractive? Is what I wanted to know.
Oh, I mean, China would have been attractive because it's down quite a bit, but China has long-term fundamental issues rather. So investors are wary. China has been a no-touch for many people, and there are some people who say, "Okay, China is ready now, get back in." But I don't agree. It's still a very erratic regulatory regime. They keep changing on a dime. So I think at this point, it's going to take a lot more. They need to really show that things are back to normal, and automatically, India going down doesn't mean China goes up. The money is not flowing that way. I think money could be flowing back into the US, in fact, if interest rates come down and the market here is very healthy. So India is, I think, at this point, the valuation is very rich. They need to self-correct a little bit. And that's what's happening there. So there's no fundamental story still intact, still the fastest growing economy in the world. That will continue. But I think at any time, a healthy correction is what you need. And that's what's happening.
Right, Santosh, healthy correction is what we need, and perhaps we have already started witnessing that. But on that note, thank you so much for taking the time out and joining us today.
Thank you. Thanks for having me.
If you like this video, then like, share and subscribe to ET Now.